African investors entrust the proceeds of their retirement savings with some of the country's largest fund managers. 4 funds from Investec, Coronation and Allan Gray alone account for more than 100 billion rand. That's actually 3 of investors' money. So tonight we asked Morningstar's David O'Leary to give us a rundown of how these funds are doing, and he joins us from our Cape Town studio. David, thanks so much. So let's look at these popular funds and why people are trusting them with their retirement savings. Big decision indeed.
Yeah, it's a very important one that unfortunately a lot of people don't, I think, pay enough attention to.
So now let's start with Coronation, for instance, and the funds there are 2 funds particularly in Coronation that are drawing a lot of interest. What are they doing right at the moment?
Well, Coronation can't seem to do any wrong. Both from a performance standpoint, a lot of their funds have performed particularly well, and they're drawing in assets. We've seen just a flood of money coming into Coronation. So they're really firing on all cylinders, which, if you're sort of looking at whether things are sustainable or not, you get a little worried that they may go through a period of underperformance, given that they've really posted some outstanding performance figures.
David, we see the IFAs often throw these 4 funds. We've got 2 from Coronation, 1 from Allan Gray, the Allan Gray Balanced Fund, the Coronation Defensive Fund and the Coronation Balanced Fund, and then also the Investec Opportunities Fund. They use these as sort of the building blocks for many investors' portfolios. I wanted to just get a sense of what the benchmarks are for these funds and what are these funds aiming to deliver for investors, and have they been able to do that over the last few years?
Sure. So to answer your last question first, these funds have done an exceptional job of producing returns for investors. So if looking at, most of them are just close to 20% annualized returns over the past 10 years. A lot of that's a function of South Africa. The entire market has done exceedingly well during that time frame, but these funds have done a particularly good job in that market. As for your comment about advisors using these funds as the basis for client portfolios, that's where I think looking at the funds and comparing and contrasting their styles and investments makes a lot of sense. To while these may be 3 excellent funds, it doesn't necessarily make sense to just combine the best performing funds. And I think what you'd probably have in a case where you bought 3 funds from each of the, 1 fund from each of these providers, is you'd have something that looks very close to the overall market, because they don't perfectly overlap with each other. And so what you'll eventually have is owning every stock and every bond rather than picking just the outperformers.
David, they're such big funds. If I remember correctly, the Allan Gray fund's already up to close to 80 billion rand. You talk about these funds. I get the impression as well that the Coronation and the Allan Gray styles are very similar. So is it actually worth it having 2 similar styles in investment decision making in an investor's portfolio, or should you rather look to diversify those strategies a little bit?
Yeah, I think the guys from Allan Gray and Coronation would point to all sorts of differences in their investment process and their styles, and there certainly are. But as far as combining 2 funds, you're not going to get a ton of extra diversification by combining these two managers, because while they have their differences, there are some similarities as well. So if you're looking at their sector allocations, you're looking at their investment style, sort of where they land on the value growth sort of spectrum, whether they invest in large or small cap stocks. They're similar on a lot of numbers, and they own a lot of they own a lot of the same stocks. So you're not going to get, you could get more diversification by adding a fund like, for example, Clyde Rousseau's Investec Opportunity. His process is much more markedly different from Allan Gray and Coronation, and so by adding one of those funds with a Clyde Rousseau run fund, you're going to get more diversification. I think the thing that I was alluding to with my first comment was be careful of over diversification. It makes sense to combine one or two funds with different styles. But if you have 4 or 5 different funds, all with different styles, you end up owning everything in the market, which sort of defeats the purpose of active management.
Would you say that Allan Gray, the star there, is losing some of its shine, to use that analogy? This is all cyclical. As you pointed out with Coronation, can they sustain their performance? Where do we stand with Allan Gray right now?
Well, I think what you're seeing is the performance numbers for Allan Gray have, for the past few years, sort of tailed off a little bit. And that's, I think, is a result of one of the distinctions between Coronation and Allan Gray, is that Allan Gray tends to be a little more value-oriented than Coronation, and it certainly has hurt to be a value investor over the past 4 or 5 years in South Africa. So I think that's what we're seeing come through. All styles and processes go through periods, and it can be very prolonged periods of success and weakness. And so I think investors probably feel like a lot of the shine's come off Allan Gray, but I don't suspect it has anything to do with them changing their process. I get the sense that it's a function of styles coming in out of favor.
David, we've got this debate around obviously the success. I mentioned the size of the Allan Gray Balanced Fund, and I know the Coronation Funds together are very big as well. How much is size affecting the performance of the funds at the moment? Is the success of the past something we can expect in the future, considering now that these fund managers are dealing with such large-sized portfolios?
It's a good question. It is a hard thing to determine from the outside. As an outside independent observer looking in, it's a very difficult thing to determine with any certain sort of certainty. I haven't gone through that analysis on these funds in particular. If I did, I would look at things like how the average market cap of the stocks within the portfolio has changed as the assets in the fund have grown. So for instance, if you are seeing the managers buy larger and larger cap stocks as the fund gets bigger because they need to own more liquid names and they're throwing around more money, that would be a negative. If historically they had been successful playing in small cap stocks from time to time or mid cap stocks and they're no longer able to do it, that would be a concern. Another thing that you can look at is how many stocks they own. So if they had historically been very concentrated and owned bigger positions in fewer stocks, and now as the assets have grown, they're owning more stocks, that would be another red flag. But it's always, you rarely get a smoking gun, so you're trying to do your best to assess it from the outside.
We touched briefly on Investec Opportunities Fund. Can you give us a little more color around this one, and we'll term them the big four for the purposes of this discussion?
Sure. So Investec Opportunities run by Clyde Rousseau. The big distinction there, so whereas Allan Gray is probably a little more value-oriented, Coronation may be a little more traditional growth at a reasonable price, even though they're heavily value-oriented as well. Clyde Rousseau focuses a lot on quality. So he might say, whereas Allan Gray might say, we want to buy a stock, and if it's cheap enough, there's a price at which we'll buy most stocks. Clyde Rousseau would say, there are certain stocks and businesses I just don't want to own, regardless of the price. And a good quality company with a good business model and a growing market share and a proven ability to generate return on equity, I'm willing to pay up for that, because you often don't get real good quality stocks at a significant discount. And he'd just rather be in those quality companies that are able to perform in all sorts of market environments and generate consistent cash.
David, just one question, and it goes back to the size thing again. We've heard a lot of commentary in reading the fact sheets and commentary from these asset managers, many of them negative around the state of the South African economy. But again, with the amount of money that they have to invest, is it very easy for them to take a position on South Africa, even when the fundamentals, the economic fundamentals and prices in the market do not look that appealing?
Well, I think I mean, I think the problem is more exacerbated on equity funds because they don't have other asset classes that they can invest in. So a lot of these funds that we're talking about are asset allocation funds or balanced funds, and the managers have quite a bit of flexibility, more flexibility than in all sorts of other funds, to invest in bonds or pref shares, hedge portions of the portfolio, purchase ETFs or commodities, things like that. So I think the problem is it's less of an issue for the balanced funds, but it certainly is an issue, and you'll notice that a lot of these funds, and I think the four we're talking about in particular, have maxed out their foreign equity exposure because of exactly that point you made, Warren. I think a lot of investors here are a little bit worried about the future of the South African markets, and so have been buying as much as they can of foreign shares.